US markets may be closed today, but the TV team is still here bringing you the news which may affect your trades. Athanasios Vamvakidis joins me down the line for the Dukascopy weekly wrap-up. Thanos, amid all the market turbulence, we've seen a flight to quality, which the SNB, for one, has tried to stay off. The Riksbank took surprise action yesterday, followed by a bit of a mixed jobs report from the US. Equities are a little lower today, but how would you describe market sentiment?
Well, the market is looking for direction. Overall, in the US, in the last couple of months, data has improved. The labor data today were slightly below expectations, but overall, data is much better than in the first half of the year. Eurozone data has been mixed, but relatively good. Overall, central bank policies globally have been supported. Despite that, we don't have strong risk appetite. To a large extent because there is a lot of uncertainty. So we will say all this leads to an equity market positioning that is cautious. Not very aggressive, but not short as well. Relatively cautious for all these reasons.
Now, we have been keeping a close eye on the Shanghai Composite, but what's your opinion, Thanos? Has the government lost control of the situation, or actually should they even be trying to control it?
Well, the central bank has been trying to support the economy, but also they understand that the fundamentals are consistent with a soft landing. So whenever we get some disappointing data, the central bank steps in with measures. However, this might have caused stretched asset valuations. And indeed, we can say that according to some measures, equity prices in China might be in bubble territory. So it has been a very, very delicate balancing act, successful so far at the cost of overvalued asset prices. So this situation, one can argue, is not sustainable, but it's very difficult to determine the timing on when exactly the imbalances will manifest themselves. So clearly the developments in China are a key risk for the global economy in the months ahead.
Now, we cannot not talk about Greece. Polls put the yes camp marginally ahead in Sunday's referendum, although it's basically too close to call. We understand a yes vote would see Varoufakis resign, but do the Greeks actually know what they're voting for? And as the country will need external help either way, are things going to get worse regardless?
Well, according to the latest polls, it seems that the result is very, very tight, which also suggests we might not get a clear picture after the referendum. But the important thing to note is that the referendum is about a proposal that is not valid anymore, not just because the Europeans have removed it from the table, but because the situation is much worse today. What they were discussing just a week ago was still assuming positive growth for Greece this year, and had not provisioned for any additional bank recapitalization. We believe that now Greece will need a completely new program with more money, substantial more debt relief, and very likely bank recapitalization. So no matter what is the outcome, the truth is that politically we do not believe that the conditions are right, both in the rest of Europe and in Greece, to be able to agree to such a new program, given that this will require more transfers from the rest of the Eurozone to Greece and much tougher conditions and program conditionality in Greece than what they were discussing just a week ago. So we believe that unfortunately things are likely to get worse in the weeks ahead in Greece, no matter what is the outcome of the referendum.
Analysts say the most expensive crosses at present are the dollar NOK and Kiwi US dollar, as Kiwi is being described as the most unloved currency. But what pairs are you favouring at the moment?
We like the US dollar because we believe that beyond the risks in Greece at this moment, markets in the next few months will be driven by divergence of monetary policies. We expect the Fed to start hiking this year, most likely September or the latest by December, while we believe that the ECB will continue with QE even after September next year because inflation remains well below their target. This goal is consistent with a weaker euro-dollar and overall a stronger dollar. Beyond the major crosses, the one cross that stands out as the most expensive according to equilibrium estimates is the Swiss franc versus yen. We wouldn't necessarily sell it ahead of Greek risks, but we believe that in the long term this will be the cross that will adjust the most because it's by far the most misaligned.
Thanos, great to have you on the show, thank you. Well, the team will of course be bringing you all the news post-referendum, but before then we have Friday's forecast, press review and community stars. So please do keep clicking back. Goodbye for now.